So welcome everybody. My name is Matthew Kessler. Today we're going to be discussing commercial real estate and hard assets for family offices. We've got an amazing group. I'll make brief introductions, not only to myself, but everybody here. And then we've got a lot of questions we're going to cover. We'll make sure that this is hard hitting, it's fast, and that each person gets a lot of time to talk about their firm and obviously talk about the market. So for myself at Partners Equity Capital, we provide capital. We provide capital to real estate sponsors across the entire spectrum for multifamily, raw land, mixed use. Our job is to make sure that you've got capital up and down the capital stack, whether it's debt, whether it's equity, and we can do deals with you to help you provide financing from $5 to $500 million. So we look forward to working with you. I'll make a brief introduction to my good friend Larry. He's there at the table. Larry is the head of Johnson Souza Group. He's involved in real estate, financial, and he's a financial economist, a broker, and advisor. He's been at his company for more than 18 years, and he got his PhD at Golden State University. Below me here is Neil McKenna. He's president and CEO of Prana, based in San Francisco. He's with his firm also for more than 25 years. And as Marty said, he buys rent-regulated housing, so we'll discuss that. He got his MBA at Wharton and his undergrad at Stanford. Deborah, to my left, Athena Investment Group. She too has been in her role and others for more than 20 years. An interesting factoid about Deborah's family is that her dad is an architectural engineer. And one of the fascinating points is that bridge behind her, her dad worked on the Golden Gate Bridge. So we'll let her talk about that as well. She represents family offices. She is a consultant to them, and most usually have their own debt or equity funds, so she helps and advises. My good friend Dino over there in New York. How are you, Dino? He's the founder and managing partner of Vential Investments. He received his BA at George Washington University. He's New York based. He's private equity. And they acquire office, life science, and retail properties in the Northeast and Midwest. And just recently, he was featured in the 2019 Globe Real Estate Forum 50 Under 40 group. So I have a feeling you're just a tad over 40 at this point. So congratulations to that. And obviously, he has an amazing background that he'll share with us. So I'm really going to start today with Neil. Neil, how are you? Nice to see you. Neil, as I said, is the head of Prana Group. They buy rent-regulated multifamily existing projects, 20 to 30 units. Prices range from 2 million to 20, and they purchase with a really good, strong base. So, Neil, tell us a little bit about your firm and how you're unique to this marketplace in terms of buying rent-regulated multifamily existing properties.
Matthew, thanks for the kind introduction, and I also want to thank Marty for putting together the panel today. As Matthew's given you the preview, our firm has done a similar type of business for 30 plus years. We started in San Francisco and New York buying rent-regulated apartment buildings, and everybody asks us, why would you want to do that? Why would you buy something that your rents are limited by government fiat? And what we found and have continued to find is that this is a very inefficient market, especially in the size properties that we're dealing in, $2 to $20 million. And we come into the market, we have the expertise by just being now in Los Angeles and New York. We exited the Bay Area about 10 years ago, just when we felt like it was getting overpriced. But we have the capital and the expertise to deal in a very regulated environment. It's not all Section 8 or tax credit type deals. It's true private market investment, but the layer on top of it is the rent regulation. And that means similar buildings have very different prices, similar units have very different rents, and there is an art and a science to purchasing buildings on that basis. And then the key thing is we have a tremendous asset management team in both markets that can implement capital improvement projects. They know what to do with vacancies. They know how to deal with the rent regulations and the like. We've purchased over 650 properties totaling about $2 billion in our 30 years of history. We have a portfolio right now of about 125 buildings, close to 5,000 units, 900 million in assets. We raise capital from high net worth individuals, family offices, usually often in conjunction with their RIAs. And that's been a steady source of capital for us. We do everything on a fund basis. That diversification helps if there's an issue with a particular property, and spreads the fund across New York and Los Angeles. And
Thank you.
like
Let me just introduce Larry, and we'll come back to you with a lot of Q&A. So
sure.
Larry and I have known each other for a while, and we've done some panels together. So Larry, can you hear me okay?
Yeah, I can hear you.
Okay, great. And if the microphone is near you, kind of bring it close to you.
Is that better?
Terrific. So what Larry brings to the table is a view that we all like, right? He comes to the table as an economist. He comes to the table with, the background of not only being a broker and a developer and a fundraiser and a mortgage broker. He just seems to be able to combine all of this together. So let's just start out with your background quickly, and then I'll lead into a question and then move over to Deborah.
Sure. I've been a real estate economist for about, almost 20 years now. I built and ran research departments for Charles Schwab, Grubb & Ellis, Norris Banks, Mellon McMahon. So I've built, run research departments at the strategy level, working with all functions within the institutional platform. Can I talk about the market rate or the below market rate market? Because I just want to get into it. It's an amazing strategy.
Yeah, well, we can definitely talk about strategies, but I really want to make sure we get your background. How is it that you came into the business? And then we'll come back and
Okay.
we'll open it up to strategies and we'll open it up to Q&A. So yeah, just really
Okay.
want to make sure that everybody understands
I
who
came
you
through
are.
the research side, of these major institutional platforms, building, running these research departments. I've worked with IT staff to develop alpha generating and index oriented REIT funds. We've done a couple of those. I'm actually building a commodities trading platform, OTC. We're actually doing an alternative investment platform right now, where we're actually brokering and probably will be buying at some point music catalogs. We'll probably even be doing NFTs off the music catalogs.
All right, now you're moving a little bit far afield. We're here to talk about commercial real estate.
That's okay. That's okay. It's all product innovation at the end of the day and strategy.
Absolutely.
It could be investment brokerage, could be mortgage brokerage,
There
could
we
be
go.
the capital stack, financial engineering, could be asset repositioning, redevelopment, acquisition, organizational restructuring. I mean, there's all kinds of way to create value across, the different platforms within real estate.
Outstanding. Thank you. We'll be back to you in a moment. Deborah, how are you? Nice to see you. Looks like we have the same bridge going in opposite directions.
Yeah.
Very well done.
Great minds think alike.
Yep, I'm here in Los Angeles, and obviously you're up in the Bay Area. Give us a quick overview of Athena, but most importantly, I think, people will be fascinated to know that your dad worked on the bridge. He's a structural engineer. You've been in the business for more than 20 years. You consult the family office. You have offshore and out of, market clients like those that possibly in Canada or in Europe. And you really have an interesting business. So why don't you just sort of tell us quickly about Athena, and then we'll come back to you with questions as well.
Sure. Thank you, Matthew. Yeah, my father was an architectural engineer. He was schooled over at the Tokyo Institute of Technology, which is the MIT of Japan, and worked on the Golden Gate Bridge Highway and Transportation District. He and his team redesigned the 128 lampposts lining the roadway on the Golden Gate Bridge in the early 70s, and also designed the Larkspur Ferry Terminal, for those that know that one. I went to Cal undergrad, UC Berkeley. Studied legal studies, thinking I minored in accounting, so I went straight to work with Arthur Anderson in the tax division. I was a total bean counter right out of college, and later on I went into graduate school for psychology. And anyway, I've been in the real estate lending business and commercial real estate as a whole of 21 years, and mostly sourcing capital and structuring debt, equity, mezzanine, bridge capital, permanent financing for all types of commercial real estate and construction projects. So I've really over the last several years, really become an expert in construction financing. I went through my own construction projects in Dallas, 2017 through 2019, redeveloping 2 properties there. So got real hands-on there, and so really understand the challenges facing the construction industry.
Nice.
And, yeah, so now I'm with my Athena Investments company. It's a capital advisory firm, and I work really closely with one international multifamily office, and they're in the business of providing private credit lending as their business, right? So it's mostly construction, financing, and bridge debt. They lend off of their own balance sheet, and they also syndicate with usually 1 to 2 other partners to spread the risk.
Okay.
Thank you.
No, very nice. All right, so we'll come back to you because there's some really nice tidbits in there I want to definitely get at. Dino, welcome. Hopefully things are going well for you in New York. Now, I know you've got an amazing eclectic background, and then I want to ask you the first question. So we're going to cruise right into ESG, environmental, social, and governance. I know how important that is to you and your firm. So quick background on you and the firm, and then let's just talk ESG and how we can really push that envelope and that theme inside the multifamily office real estate business.
Yeah, thanks, Matthew, and pleasure to meet everyone on the panel and online and in person. Thanks for having me. My name is Dino Christoforakis. I run my platform, Vential Investments, which I started early this year after a 17-year career on the corporate side. I've always been on the principal side of commercial real estate. So I've always been doing acquisitions, asset and portfolio management throughout my career. I got started in development, and then shifted over to the private equity side, worked for pension fund investment foundations, global investment managers, and other institutions. And then with my firm, we're helping family offices and individual high net worth investors take money off of Wall Street and put it into Main Street, as we say,
Nice.
In real estate. So we are deploying capital in the form of co-GP and LP. And we're asset agnostic, opportunistic. If a deal makes sense, it makes sense. Right now, we're much more bullish on the residential sector, multifamily, single family for rent, and other niche areas, which I'm happy to talk about. I think there's going to be opportunities in other areas, but that's pretty much us in a nutshell.
So let's go into ESG. I know it's been for me, you know, as a mortgage broker, and I talk to my family offices, they're always wondering, okay, I really want to make sure I push this ESG theme. I don't want to just sort of do greenhousing here. I really want to care about the environment. I care about social. I care about governance. How can we do this better inside the multifamily office?
So in my eyes, Matthew, ESG, well, first of all, ESG is in everyone's mind, right? Everyone's agenda. All the institutions want to check the box. Every sponsor has to check the box. But for us, it's really much more than just checking the box, right? So we have to look behind the scenes, behind the curtains, and make sure that we are underwriting deals that they work pre-ESG strategies, right? So if a deal makes sense, it makes sense. I don't want to take cash flow and yield off of a real estate transaction just because we have to have an ESG component, right? Yeah. So in order to achieve that, we do 2 different things. First of all, we pay a lot of attention on the sponsor, on the manager. We found that groups that they are emerging managers, smaller in size, they tend to innovate a little bit faster, better than others. They have a unique expertise, either sectoral or geographical. They have deep ties with the local communities, and they tend to innovate a little bit better. And the second thing on the innovation side, right? We pay a lot of attention on new technologies and new ways we can get more sustainable on the construction, on the building, on the management of all sorts of real estate, whether that's a single family home for rent, or a multi-story office building in the heart of Manhattan.
So Neil, let's pick up on, you know, your business and let's talk a little ESG. Now, you know, if, as we talked about, multifamilies care about, you know, location, quality of the building, positive cash flow, access to easier and better financing. But your firm sort of has a different take on this. How do you raise money? And do you have an ESG theme? And tell us about, you know, I'm a family office. I've got $100 million burning a hole in my pocket. How do I find you? How do I find Prana? And how do I work with you?
Well, this is a start on this call today as to finding us. We've been doing this for 30 years, and we've been investing in low and moderate income neighborhoods that entire time in San Francisco, LA, and New York. And as I mentioned at the outset, our goal is to provide capital to enhance these buildings, the management expertise to make this a better living space for our tenants, and then also provide, to Dino's point, provide a good return to our LPs, which are primarily high net worth individuals and family offices. And we think we can take care of all of those components. And, especially, and I know you're going to touch on some of these things later, Matthew, about interest rates and inflation. It's getting more and more costly and more difficult to develop. So existing properties, we buy buildings were largely built in the 1920s, 1930s, spend the money to make them better. And that would be everything from energy efficiency. In New York, it's a very relevant topic, but even in Los Angeles, that's key as well. And then we're creating, as I said, a better living environment for our tenants. And we're buying buildings at $150,000, $200,000, $250,000 a unit, and to develop in our markets is $800,000, $900,000 a unit to develop in these markets for quote unquote affordable housing. So
wow, so I can see the ESG there, right? Because you're taking an older building,
we're providing
really
the bridge
enhancing
in the market to maintaining these properties, which are very much needed. Our demand is, the only units we have vacant are units that we're in the process of
converting. Right, exactly. So let me go to Larry. Larry, let's pick up on where Neil left off, and I think he was talking, Fed and interest rates. The Fed is raising interest rates. What does this mean for commercial real estate? And more importantly, I think we've got a problem on the lending side. We've got a problem with LTVs going from 75 to 50, and then we've got a problem with rates, really moving north. So what's a family office to do? How do you advise them at this point?
Well, hopefully they didn't get over leveraged on a lot of their properties, particularly shorter term debt that ends up being reset at the higher interest rates. That's going to put a squeeze on them. So, and I know that the family offices are normally very conservative in the application of their leverage, so that should give them, some cushion. In regards to multifamily is a great property sector. Because if you do run into any economic occupancy issues or physical occupancy issues, you could always lower the rent or give incentives to be able to bring those physical and economic occupancy rates back up. That's not the luxury for maybe industrial now, but that's not the luxury for retail, not the luxury for office buildings. Plus, you have Fannie, you have Freddie, you have HUD, you have these financing mechanisms that are available to multifamily that's not available to the other commercial sectors, which gives multifamily a comparative advantage over the other property sectors. So, I love apartments, low volatility, demographically driven, economically driven, affordable, and easy access to the financing. It's just a better sector from a return to risk standpoint.
So Deborah, staying with, Larry's theme and family offices and why it's so amenable to their portfolios and works. And, to Neil's point, you can take any type of an asset, improve it, get better cash flows and, help with ESG. And then back to Dino's point, obviously, being involved in multifamily real estate, there's so much upside. So my question to you is, how are you advising your clients right now? Are you advising and saying it's okay in this interest rate market, continue doing what you're doing and go into multifamily? Or have you moved them to a different asset class within the commercial real estate sector?
So we're seeing a lot of opportunity in multifamily, and I'll break that down a little bit with, we do some student housing, some senior housing, and also some emergency construction post Hurricane Ian in Florida. So, and we do some industrial and very limited hotel. That's been a huge change. I mean, I'm talking just real recent within the last couple of weeks since the last hike on September 21. So, so those are the asset classes. And did you have you had the other question about interest rates, what my thoughts are on that?
Yeah, I'm just thinking,
Yeah, so a lot
family
of,
offices love multifamily. Are you
Mhm.
staying with the multifamily,
Yes.
or is it stretched now, or are you really leading them to another
Yes,
asset
so how
class?
we are able to fill in the gaps where a lot of lenders have left um, is in the high leverage, because obviously if deals do pencil, the few that do pencil, sponsors, developers, they can go get their agency debt from Freddie Mac or Fannie Mae, FHA, and if not, they come to us, like private credit, especially for problematic loan files, or if they need higher leverage, and we can go up to 80-85% loan to value or loan to cost, depending on whether it's a construction or existing building. And we stay very, very competitive with the interest rates, because we're keenly aware of what other private credit facilities are offering. And we also shop around for the best global index or indices. For example, when prime rate was getting unbearable, we switched over to SOFR.
Okay, okay, that you have to,
Yeah.
because clients understand that you've gone from prime to SOFR. They're looking, at their local bank rates. They're looking at their mortgage rates. They're very hip to what's going on. I must have 5 different mortgage apps on my own phone. I've got CNBC on in the background all day long. So, right, I think our clients are very in tune. So, Dino, let me ask you a question. I know you and I have talked about this before, that a client comes to you and he wants to show you a deal or do a deal with you. It seems like you're very comfortable saying no to clients. How do you do that?
Yeah, so you're talking a scenario where we get a deal in our mailbox from a sponsor that we work with. And, a lot of the times over the past few months with the interest hikes, we've seen deals underwriting double-digit rent growth and very aggressive assumptions on the back end as far as exit cap rate is concerned, right? So that's a huge red flag for us. I don't think double-digit rent growth in most of the instances is something that's very sustainable. And as far as the cap rate is concerned, I mean, we're all living in an inflationary environment, right? So I would expect to see some cap rate expansion, absolutely on paper and definitely in real life as well, right? And then just going back on the capital stack, before the interest rate hikes, we've been getting financing for multifamily in the 80-85% range,
Nice.
Deborah mentioned, right? Now that same deal, same debt will probably be in the 60% range. So you have 2 options, right? As an investor, you can either go to Deborah and have her work her magic and put together the deal, or you can write a bigger check as far as equity is concerned, right? So we do primarily for right now, because I just met Deborah, we've been writing larger checks, and people were just getting comfortable with that. And I think that's part of the reason why we haven't seen cap rate expansion very significantly kicking into the multifamily space, because institutional investors have been extremely well capitalized over the past 10-15 years or so. So there's a lot of
And they're
dry
sitting
powder.
on so much firepower right now.
Exactly.
It has to be invested. So let me move on to Neil. Neil, let's talk about that firepower. There is so much capital sitting on the sidelines, where it's institutional family offices or endowments or foundations or Taft-Hartley in the union world. How are you discussing their asset allocation, and do you ever turn away money, or are your doors open? Do your funds ever close, or are you evergreen?
Well, we have a combination of evergreen funds and we have self-liquidating funds. But our best funds were self-liquidating funds that we raised capital in 2011, 2012. And we actually think today is a similar environment, at least in our segment. There's been a lot of dislocations in New York, as
Nice.
Dean probably knows, that's independent of the market cycle, some changes in the regulations in June of 2019. Rent-regulated apartments in Upper Manhattan, where we invest, declined by 40% in pricing. In the Bronx, 25%. So, in contrast to much of the rest of the United States, as far as multifamily goes, there's great opportunities already in New York. Double-digit average yields on an operating basis over a 5-year period. And so that's what we're focused on, is getting the yield for our investors, capturing that now. And New York, like Los Angeles, we think is going to come back from the.
Let me ask you a question. You and I talked about transfer tax revenue to certain cities. Are you seeing that same transfer tax revenue that could possibly dissipate in New York City as well as in San Francisco? Is that something that's bi-coastal?
Yes, I would say it's a real issue for particularly San Francisco and New York, which are highly dependent on the transfer tax. And we haven't even really touched on something that a market segment that nobody likes to discuss these days, but office. Again, New York and San Francisco are going to be hit hard as governments, for their property tax revenues in both markets for their office buildings. I would expect.
Well, let me bring in the Economist. So, Larry, let's talk about that. I mean, the transfer tax issue in Oakland, in San Francisco, in Silicon Valley, that could be a real issue for services. Could you help us a little bit and help the multifamily office or the family office understand, hey, I'm about to make some investments in some really interesting plays here, or through some funds, or with Neil. Should they really be thinking about the, this tax, or is that not important to them? But I know it's important to Oakland and to the cities themselves.
Tax is definitely one of the issues. But, if you look at San Francisco, I mean, we're here in beautiful San Francisco today. You look around, these buildings are probably 70% economically occupied right now, but they're about 40%, 50% physically occupied. At some point in time, those leases are going to burn off. There's going to be a reset, in the leasing market. There will be a reset in valuations. There'll be a reset in the mortgage market. So it's coming, and we probably had some optimism, looking out if the economy had continued to grow and peak. But with the Fed, being aggressive on interest rates and the impending recession, office is going to get hammered again. So I'd be focusing on multifamily.
So you're comfortable saying office is going to get hammered again. So let me just ask you a question.
Yeah, it already got hammered, and it's going to get hammered again in the recession, particularly as the leases start burning off and your economic occupancies start to collapse to the physical occupancies.
So
you own the
here's
building
my question.
free and clear.
So my question to you is, okay, I've got this burn rate going on in this office building, and let's say that an investor comes to you with a deep pocket. What would you do with that office building? Would you go in and retrofit it and turn it into long-term healthcare? Would you turn it into co-living? What would you do with this, not viable asset, which is called an office building? What do you do today?
Well, those are, pie in the sky dreams to think that you can retrofit an office building to life science, or, upgrade it to, condos, or, apartments. I mean, that's really hard to do. And a lot of the stock is actually functionally and physically obsolete. You're probably better off just tearing it down and building a higher and better use. But if you've ever developed in San Francisco, that's really easy to do. And it's easy to, change use, to higher and better use. So it's a major existential issue. And you're right, the tax revenues, that basically supports the bureaucracy. If that starts to come down, then you're looking at maybe some major headcount cuts, in the bureaucracy in the city and county of San Francisco.
So wait a minute. We could all be hybrid workers here. So Deborah, let's talk for a second. So let's talk quickly about hybrid investors, or a hybrid employee. And, to take up Larry's point, okay, I'm a hybrid employee. I really don't want to go back to the office. And every single major bank on Wall Street has said, get your butt back in the seats. And if I can't count you, you're fired. So we know that that's going to be a big problem for office buildings. But let's move beyond that for just a moment and can continue to think about hybrid, and legal contracts, because I think legal contracts with families, when they're about to write an LOI, what are they really thinking about in terms of when they buy a property? So before I buy a property, I have to put out an LOI. I have to think about how that property is being used, how do you work with, I guess within your own firm or firms outside? When do you start bringing lawyers in and saying, okay, we got to get these contracts tight because I've got a lot of issues here. So let's talk law, let's talk legal, let's talk LOIs, let's talk about the right time to bring in a lawyer if I'm a family office about to write a check.
Right. Yes, we have in-house counsel as well as outside counsel for this purpose. So instead of an LOI, we typically issue a full-blown term sheet. And it's quite daunting. It's like 10, 12 pages. And it's exactly for that reason, to protect ourselves when things go sideways. And this international family office has been lending off of their own balance sheet since 2012. So you can imagine by now, it's like a piece of art. This term sheet is beautiful. It's near perfect. So it covers, for example, or most importantly, material changes in the financial markets right now, and the clauses that talk about our satisfactory review of a lot of due diligence items. And another way we protect ourselves is that we have the sponsor's accountant. It could be an in-house accountant. It doesn't have to be a CPA, but we need that accountant's signature with their own personal notes, which indicates that they have reviewed all the financials. There's very important bad boy carve-outs that even though most of our loans, like 90% of our loans, are non-recourse, the sponsor still has to sign the loan docs on bad boy carve-outs like interest carry and bad acts and so forth.
Of course. So let me move on quickly to
Sure.
Dino. Dino, you underwrite sponsors sometimes, right? So to pick up on Deborah's theme or Deborah's thread, when are you underwriting some of these sponsors? Walk us through what a typical scenario would be like when you underwrite a sponsor, because I think it leads to, okay, I've got a term sheet, I've got a lawyer, I've got an accountant, now I'm a family office and I'm thinking about, underwriting. Can you help us there just a little bit to help that family office that's listening today understand what it is to work with somebody like yourself?
Yeah, it's a lot of, there's no surprises, right? We're focusing a lot on the track record and the history and who the principals are. Have they ever lost money on any deal? Do you have any reputation that's kind of sketchy and questionable? We do ask for references and we always follow up on those references. We do look at fund historical performance, if there is a fund in place. If everything is an SPV, we're looking at specific property performance. Diving into the nitty-gritty, always ask to get the Excel spreadsheet, look behind the scenes, behind the curtains, and understand how they are underwriting those transactions. So there's a lot of quantitative and qualitative underwriting that's happening on our behalf, on our end. I would say nowadays even a lot more on the qualitative side. We're spending a lot of time via Zoom and most importantly in person with those managers when we do the underwriting.
Very important. And Neil, you and I were talking earlier in the week about an interesting transaction you're working on in New York City, where you're trying to pick up an eight building portfolio. And to you become the hero to the bank that's trying to get rid of this loan. Talk about that, because I think, and I know Larry will want to pick up on it. We're going to run into this headstorm where a lot of banks are just going to put portfolios up for sale. And there's going to be guys like you and Larry and myself and others that are going to have capital. So talk about that deal that you're working on, $100 million, 8 building portfolio. And I'm sure this is just the tip of the iceberg, where I think a family office could really do well if they know what they're doing or hire somebody like yourself.
Yeah, thank you. Yeah, that just is a follow-on from where I was talking about in Upper Manhattan, values declining by 40%. So this is a portfolio that was purchased in 2018. Our main bank financed this. It's another group, and the group is dissolving because they paid too much and can't sustain it anymore. And the bank doesn't want to take these properties back. So it's got to find a way out of it. In contrast to 2010, 2011, where interest rates were so low, and in our segment of the business, rents were always going up. Residential rents in the rent regulated space have never declined in our portfolio in 30 years. So at that point in time, investors could refinance at lower interest rates than they were paying in 2006, 2007. We have the opposite issue today where interest rates are up. If someone bought a building and can't make it work, they're not going to be bailed out by low interest rates. So the banks are going to have a lot more of these types of portfolios. Now, it's not a straight line to get access to these portfolios. You know, there's usually a lag of anywhere from 9 to 24 months before the bank sort of gets control of the situation. But, you know, I think there's going to be a lot of opportunities out there in certain segments of the market. And these operators are not going to be bailed out by low interest rates again.
And
Larry, by the way,
please.
By the way, I think that's exactly what's going to happen with office, right? That's why we're going to start seeing some blood on the street when some of that debt is rolling in, and a lot of those assets are going to get to the point where they need to get refinanced. And I'd like to say that history repeats itself, because I think what COVID is doing to office right now is similar to what e-commerce was doing and is still doing to retail, right? So think of the shopping mall, right? It's been booming for decades. Everybody had a shopping mall in their neighborhoods, and then suddenly we were overfilled with dead malls, right? But until we got to that point where pricing really, started getting down to the level where it was making sense for opportunistic investors to pick up those assets and retrofit them or even tear them down as a hybrid land play, we didn't see a lot of activity. So I think some of that is going to start happening even in office, right? When is that point where pricing will come down enough for investors to hop in and retrofit those buildings? That's a big question mark.
Wow. Larry, do you want to pick up on that? I mean, I think that's a really interesting theme.
Yeah, I'm thinking about CMBS, as an opportunity.
Great.
You got rising interest rates due to inflation, higher inflation expectations. At some point in time, the market's going to start pricing in those credit default risk premiums, and that's going to be the leading indicators when the spreads, start widening on the CMBS. So I'd start looking at the default risk premiums and the spreads starting to blow out. And at some point in time, if you could time that, on that paper, I think there'd be some really good opportunities for some opportunistic plays, on the CMBS side once the spreads blow out.
And I think especially the tranches that have San Francisco and New York office buildings in them, if you can refine it down to even a more basic level, I think you're going to make a lot of money. It's beyond my level of expertise, but that's where I'd focus efforts if I had was looking at the office market.
Right, because you and I were talking about that earlier, Neil, about that there's just going to be a blowout. Let me go back to you, Larry. If you were going to put together a portfolio of CMBS and you could be choosy, are you looking West Coast? You looking East Coast? You look in the city of Austin? Where are you going to try and find these bonds? And if you put portfolio together, how big does it have to be?
At least a couple billion, for the distressed debt side. I mean, a minimum on that side. And I would be focusing to the urban core markets. San Francisco is a perfect example, of a contrarian play, on the distressed debt side. I'd be looking at New York too. I probably wouldn't go into Miami. I wouldn't go into Austin. I mean, those markets are still, really hot. They're still seeing a lot of, migration of firms, into those areas. They're starting to see some new construction. I think those desert mountain, tertiary markets that have comparative advantages will probably hold up well. I'd be looking for the urban core markets to pick up some cheap debt at some point here.
Okay. So Deborah, let's talk, look, we just entered Q4. We're about to move into Q1, 23. Is there going to be a surprise breakout asset class? I mean, we're all going to go, oh, God, well, we should have seen that coming. Do you think something's out there in the next 6 months through the end of Q4 and into Q1 where we think, wow, this is a great time to deploy money in this particular space? And I'm sorry I didn't do it earlier.
I think multifamily is still great. I think the surprise might be from a speculative standpoint, it might be senior housing, with the baby boomers still, those numbers are so massive that post-pandemic, these senior housing facilities have recovered quite well. And I think there's so much demand for that. And I would choose that as a secret surprise.
So that's your secret sauce. Dino, do you agree with her that the secret sauce is senior housing? Or is there something else that we should be looking at as a group? Because we're all stewards of capital. We all advise our clients, and clients are listening on the phone today like, okay, where should I be going and what should I be doing? Is now the time to be looking at senior housing, or should we be going in a different direction?
I love healthcare and outpatient facilities. It's a theme that's fascinating. And if you think about it, 23 is going to be the first year in the US history that we're going to have the same number of high school graduates as retirees. So that cohort, the baby boomers that Deborah mentioned, they're coming of age, right? And they're going to be retiring. They're going to need, be taken care of, healthcare wise, housing wise. It's definitely by far the largest cohort, right? So, if you want to think about the future and do a little bit of brainstorming, I think opportunities are going to be definitely that space, senior housing for sure. Anything residential, the fundamentals are super strong in the United States.
Yeah.
We're not building nearly enough.
And
Absolutely right.
another related area is what we call age restricted 55 plus for active adults. I'm getting a lot of requests for financing for those construction. Those are still very strong and growing.
Neil, let me go back to you and let's stick to, what Marty's request was, talk a little bit about, the West Coast. You and I had a conversation about the city of Oakland. They lost the Raiders to Vegas. The Oakland A's, are owned by the son of the Gap. He's thinking about moving, the team to Vegas. The Golden State Warriors have moved out of Oakland. Why so much disconnect in sort of that San Francisco, Oakland area? And how does somebody take advantage of it?
Well, I think Oakland's a relatively small city and just doesn't have the financial wherewithal. It needs someone like the owner of the Warriors or the owner of the 49ers to do a privately built stadium and not rely on government money. And I'm not sure whether the owner of the A's is up for that task. But I think Oakland's a small city with big city problems and just doesn't have the financial wherewithal to make it work. If you look at a map of the Bay Area, Oakland should be the center of the universe. It's at the crossroads of all the transportation elements in the Bay Area. It's geographically much better located than San Francisco if you're a business and you need to access all aspects of the Bay Area, but it's never been able to sort of create the momentum to get there. And I think it's a sad state, but I don't see it getting out of there. San Francisco, for all its problems, has a lot of financial wherewithal. And if it ever got its act together, could address a lot of those problems. I'm not sure Oakland can.
Wow, that's interesting. Larry, you're a San Francisco guy. How do you feel about, your own backyard? Or are you a player? Your client comes to you and says, I've got fresh capital. What are you thinking?
If I was going to go to the East Bay, I'd probably go over to Emeryville. I like the life science cluster over there. I like, Mission Bay. I mean, the peninsula and around Stanford's like tight as a drum in regards to life science and apartments. I do like Davis next to the university. I love university plays. Student housing is one, but I also like any retail or apartments close to universities, close to transportation nodes, airports, medical centers, hospitals. It's always a good play to get close to those growth poles within those commodity markets within a mile, from them. So that's a great strategy too. Oakland's got its problems, but it's like the Greenwich Village. It's a release valve for San Francisco. It's the hip place to be, these days. They've done a nice job around the lake over the years. But again, like Neil said, it's it's a secondary city, and just the level of administrative administration and mismanagement by the public officials is endemic there, as it is endemic here in San Francisco. I don't mind
So,
bashing those guys.
nah, let me stay with you for a second. Let's talk family offices. Are they well capitalized? Do they have enough staff? Do family offices have enough expertise? Or do you find in your dealings with family offices that they're actually outsourcing all of this? And is that why some tend to gravitate to a multifamily because they can sit back and just let somebody else do the work? What are you seeing out there?
That was to me.
Yeah.
Why wouldn't you? Why wouldn't you? You know, depending on the size of the family office and be able to, you know, cover those administrative expenses. Why wouldn't you outsource, you know, your expertise, you know, to different managers, and then actually diversify across different manager strategies, across, you know, different property sectors and different strategies. So you're getting not only alpha diversification, but you're getting beta diversification when you do the outsourcing. So it's almost like a postmodern portfolio theory, creating, you know, those outsourcing capabilities and then pitting managers against themselves to perform.
And then, Deborah, let's go right to you. Talk about inflation. I mean, you know, the numbers are out of control. The Fed keeps raising rates to put inflation in check, to make it more affordable for people to get back into, you know, multifamily apartments or to buy. You know, do you see a big problem within family offices that they're going to hold back on their investing because, you know, inflation and rates? Or do you think it's just, you know, it's business as usual? We've got 15-year time horizons.
Right. There's been some capital preservation, but we're moving along with, you know, first mover position we're very competitive. So, for example, during the pandemic, we were one of the very few lenders, the only one I know about, that would even finance hotel construction, especially 2020. So, in 18 months from August 2020 to February 2022, we closed and funded close to 3.2 billion in debt financing. So it's extraordinary. And if that's not just hotels.
So the inflation really isn't stopping you. It isn't putting you in your tracks. It's not sidelining clients. They're still thinking 15 years out, right? So they're still doing their thing is really my question, right? They're still going out.
Yes, we are. Yeah, we focus on short term. We like to stay in the short term, you know, construction, bridge financing, and we do a tiny bit of permanent financing. So we think in this, you know, in like 3 to 5 year terms.
So Dino, let's talk a little bit about, you know, let's go back to where Neil's neighborhood has been, and he's sort of not really doing a lot of work in, you know, on the West Coast. You know, he seems like he's got some of the boroughs nailed down. What are you seeing in the New York area for the New York family offices or the West Coast people thinking diversification? Talk to us a little bit about what's going on in some of the neighborhoods within New York so we get a better feel of, okay, is there really, you know, a disconnect between, you know, West Coast and East Coast? What's taking place in New York? Give us sort of a feel about the market.
I think it's a very similar situation with the California market, and especially the Bay Area in many instances. New York area has desperate need for housing, for example, right? And with the 421A expiring or expired, it's virtually impossible to make sense of new development as far as residential is concerned, right? On the other hand, prime example of, you know, public and private and, you know, those two sides working effectively together is the rezoning on the Brooklyn side, where, you know, we see opportunities for thousands of units to be built. So diversification wise, I mean, there's definitely going to be opportunities in many markets. East Coast is experiencing a lot of growth corridors, especially down in the Sun Belt and the Southeast states, where the fundamentals are very strong. We see population growth, we see income growth, we see diversity of employment base and options, and most importantly, we see infrastructure investments, right? And by the way, with recent hurricane, that's another topic that we pay extra attention to is, you know, how to become, you know, weather resilient, right? And you know, we've seen bridges collapsing with the waters rising, and we cannot build the same way we used to build 50 years ago.
No, you
We have to
cannot.
adapt. So it's a lot of things that we're paying attention to.
So, Neil, let me ask you a question about sort of the Blackstones of the world and the BlackRocks and the Apollos. They're buying homes to rent, putting it into, partnerships or into investments and selling them obviously to their institutional clients and those that are looking for yield. Do you like the idea of the big portfolio of single family homes to rent? And do you think that they're taking over too much of the market? Should there be any kind of regulation there, or do you like what they're doing?
I'm not as familiar with that market, but it doesn't surprise me. I mean, the American dream is a single family house in the suburbs. So, they're playing on that. That's one of the reasons we see in San Francisco and LA and New York, it's so difficult to build new multifamily, is a lot of the people that own single family residences don't want additional development near them. So I think it's not surprising to me that someone's figured out that there's huge demand for single family homes, especially in nicer suburbs. And if they can make that work, it doesn't surprise me that that's a good business model. From a public policy standpoint, it's probably not great. I mean, there's people that would love to own a single family house themselves rather than having to rent it. And, that props the bottom end of the market up probably quite a bit, and makes it less affordable for someone to step in to buy a house.
So,
Yeah,
Larry,
we're actually spending a lot of time on the SFR space, and especially the BTR, which is the build to rent, purpose-built single family for rent communities, right? We have a little bit of a different view than Neil. We think that it's a very healthy sign of the economy that we're building housing. At the end of the day, it's housing that we didn't have before. Just to give you an idea, with the current pace of building homes, right, we're probably going to take the United States maybe 18 years to cover the demand for housing. And we see that, it's a healthy market, right, with inflation moving up and down. So home builders, when interest rates go up, people don't want to buy houses, right? So what they do, the same home builders that they sell the houses, now they put them on the market for rent. This is going to continue being the case. And at the same time, not everyone wants to be a homeowner anymore. People, especially the millennials, Gen Xers, they're moving around. They're being much more flexible and agile. They want to grab a job on the West Coast, and then a couple of years later, they're off on the East Coast, right? So it doesn't really make sense economically for them to purchase a home, and they'd rather rent. So the ease of renting has a lot of benefits, and it's a concept that we're fascinated with. I think
I'm 35 years old. I've got 3 kids, and I want to just sort of grow my lifestyle. When do I get to buy a house? I don't want to rent a house. When do I get to buy? Isn't that going to be the argument that the Blackstones and the Apollos are putting these big pools together? They're doing, they're purchasing the homes and they're renting it to me. When do I get to own my home?
So even if you look at raw numbers, right, the percentage of for rent single family compared to the stock, that the entire pool is tiny. Like you're talking about 1%, 1-3%. I don't remember the exact number, but it's a very, very small number of rental homes that these big giant companies that you're mentioning actually control. So definitely a lot of room for growth, and we'll see more investors and more capital flowing into the space, more innovation, more disruption. And at the end of the day, investors, we are guiding them towards the SFR space, that BTR space, because you're investing in the US housing stock. Think about how many multiple exit points you have, right? Even if you don't want to rent anymore, you can subdivide and put it on the sell market. So right. There's definitely risk adjusted returns there to be made.
Yeah, well, building on Dino's point, I mean, I think one thing, if we're looking our way forward economically, and one thing that there's tremendous demand for is housing, and we got to figure out a way to get more housing built, whether it's the Blackstones of the world or however it happens. We need to get more housing built, and that's definitely one way to do it. And I'd like to see more of it in the cities, because I think it's actually environmentally better for everybody to have more density in our cities. But our cities have proven to be not up to the task of getting the housing units built.
So Larry, let me come to you. If you have any comments on our past discussion with Dino and Neil, please go right ahead. And then I wanted to ask you a different question about retails and retailers. So did you want to comment at all about the Apollo and the BlackRocks and, putting together homes and then renting those out? Is there something there that you thought was relevant that you want to sort of pick up on?
And I think Dino's right, that is a small fraction of the total housing stock. So there is, growth opportunities there. What I like about it is they got an exit strategy into a liquid market. So they could always flip it from rental to own. You already got the in-place person that wants to buy the home. Why don't you flip it from equity to debt, and then you underwrite the mortgages and you have a mortgage pool? I think it's a pretty brilliant, liquid exit. And then lastly, what we need is basically supply side housing policy coming down from Congress. They've really backed away from that over the last 10, 15, 20 years. They did a great job, over the first 50 years. I think more supply side policy coming down from Congress, and then leveraging the GSEs, the government sponsored entities, to create liquidity and create housing stock would be the solution to the housing problem.
We have a couple of minutes, but I really wonder how much of the supply side issue is based on policy because of all the defaults in 2008 and the foreclosures that maybe I think people thought there was overbuilding going on.
Well, supply side policy in the United States over the last 80 years has actually put the risk of overbuilding onto the developer. And then actually the overbuilding during the down cycles created affordability and allowed for people to actually get into housing. So it actually—
I'm not disagreeing with you. I'm saying I'm wondering if there's a policy error at the higher levels of government, right? Because at one point it was a big agenda to push home ownership, and that kind of fell by the wayside post 2008.
Well, that was a major policy mistake, to push, home ownership and then not even underwrite the credit risk, and then let the banks basically, fund these alt days and these subprime. That was a total disaster.
Exactly.
So let's just go ahead with closing thoughts. So Larry, since we're with you now, any closing thoughts for family offices and things they should be doing now as they get ready for the next 6 to 18 months in terms of investing and diversification?
Patience, underwriting, do your due diligence, do your sponsor due diligence, do your manager due diligence, pick the right manager, that can execute on the strategy. Stay under leveraged, stay conservative, and then be ready to pounce when the opportunities are available to you, and have some managers that can execute.
Very good thoughts, Deborah. What should we be thinking, and what should we be talking to our clients about for the next 6 to 18 months? We're moving into an election season, obviously, in the next 30 days. But long term, same question I gave Larry. Closing thought: what are you telling your clients for the next 6 to 18 months? What they should be thinking about?
Focus on multifamily, and I don't know if we talked about the out migration. The San Francisco Bay Area is like a donut, which is the same in a lot of other metropolitan areas around the country, where a lot of the wealthier families have moved out of the urban core. There's a hole there, and then they've moved to the outer fringes, like in the Bay Area. That would be northern and southern fringes, Marin, Napa, Sonoma, Santa Cruz, and Monterey. They actually tracked the tax returns and have shown that the wealthier families have moved out to these areas.
So what do you want them to do for the next 12 to 18 months? What are you thinking? What should they be thinking? We now understand your donut. What do you want them to do with this donut?
Yeah, invest in multifamily in these secondary. Some of them are tertiary markets in the fringes there, and there's also another category called new gateway cities that a lot of folks don't even think about.
Oh, we think about it all the time. I mean, that's something that investors are there. So Dino, we're hearing do your homework. We're hearing good underwriting. We're hearing multifamily. We're hearing gateway cities. Next 12 to 18 months, what should we be telling deep-pocketed investors who are now thinking, okay, I'm ready to diversify again?
So here's what it comes down to, right? Generate alpha is like looking for a needle in the haystack in the current environment. We do all the legwork for you. So work with us. We're here, and the other topic that I want to pay attention to, I want other people to pay attention to, is find those managers, those concepts that they're early adopters of new technologies. I think that's a new disruption in the future.
Very nice. So Neil, looks like you get last word. Again, we're thinking, 12 to 18 months out. You've got clients coming to you, banging on the door, and they've got, big portfolios. Should we, monetize them and move on and take cash and redeploy? I've got fresh capital. How do we help some of these family offices think through the next 12 to 18 months?
Well, obviously it's self-interest on my part, but multifamily is the place to be. As Deborah,
There's a surprise.
I just point out a couple things. One, I mentioned earlier, our investments in 2011, 2012 paid off in a big way, and we think we're
Vintage year.
entering a similar market. It may not be here today, but 6 months, 9 months, 18 months from now, that could be a great time to invest, or it will be a great time to invest. The other thing, and we've touched on a little bit in our conversation today, is look for groups that can continue to grow their revenues and match up with inflation. So happens our segment, we've beaten inflation by about 200 basis points on our rent growth over 30 years. And again, we'd hang our hat on that in a higher inflation market that we're in today. So those are some of the
Marty, it looks like blood on the street. Be an investor. Don't sit on cash. And if there's an opportunity, go get it. Be diversified. Take risks, because you've got to be able to grow your portfolio. This is either 2015, 18, or 2000 again. You need to diversify, and you need to have really good due diligence. So it sounds like some really good ideas here. So back to you, Marty.
Great job, guys. Thanks so much. So I just want to, I always like to think about 2012 when a lot of the single family housing funds were put together. And so in 2012, I think that Tempe, Arizona had about a 13-month backlog in single homes for sale. And then all these funds swooped in, and within about 2 months, they had about a 1-month backlog because all these funds swooped in and just bought up the property. So that was an intriguing time. I also remember a time when workforce housing guy came to me and said, look, I've done a lot of workforce housing, I'm wealthy, but my best deal ever is when XYZ city in the New York City area didn't know what to do with a bunch of public housing that had bad oil tanks. So they had fallen adrift with some compliance issues. They didn't, these were housing that was built in the 1930s and 1940s, so they didn't have like metal underneath the buildings. So they were afraid of, oil seeping into the ground, causing all kinds of problems. And these old oil tanks had gone bad. So they didn't know what to do. They contacted this guy who's super wealthy, workforce housing guy. Said, what should we do? He said, just give me the property, I'll get it all fixed up. Because they were estimated it's gonna be like $10 to $20 million to fix it. So basically the guy, worked with his guys and said, look, why don't you guys, he called up the gas company, says, look, I want to convert all the heat in these buildings to gas. And, how much is that going to cost me? He says, we'll do it for free. The gas company said, and he says, great. So he got the building for free. I think he sold off the first third of it, he sold for $50 million, and he's still selling parts of it. So it's just intriguing because there's always, opportunities and arbitrages, especially with a non-financial owner. So
I've heard similar stories like that about, oil tankers to gas. You're right. I think being opportunistic, right place, right time, deep portfolios, being able to make a decision and, going forward. So thank you very much for hosting us today, Marty. And thank you for obviously putting all of these events on. You do an amazing job, and we're all very lucky to be a part of this.